We are keeping the outlook for the global reinsurance segment as stable, and this reflects our cautiously optimistic view on the segment. On the one hand, what we see is very positive technical results which have been posted for Q3. This has been combined with investment returns, again on a very positive degree. So the high interest rates which explain the unrealized investment losses at the end of last year, actually this year have turned into a positive contribution in terms of reinvestment rates. There have been some recovery on those investments as well. So all in all, what we have is a very positive picture which is translating into high ROEs. Now, having said that, on the one hand, this is catching up still from several previous years of technical and operating losses. And on the other hand, we don't see this as being necessarily sustainable going forward, given this reliance on investment results. On the technical side, it's clearly a reflection of de-risking measures that we believe are here to stay. It's not that cat activity has subsided at all. On the contrary, it continues as ever. But there has been this rebalancing act between the reinsurance sector and the primary sector. We have seen most of these cat loss events are being absorbed by the primary sector, which has been forced to increase the retention levels. Reinsurers are a bit more isolated in that respect, and we don't think that this is going to change in the near term. So there is still some pressure on that, but we think that companies in general are going to remain stable in terms of technical results. So now, having said that, what we still see is a very significant level of uncertainty in the market, not just in terms of underwriting risks, but the geopolitical environment, the economic environment, concerns about inflation, both social and economic. Yes, we have seen very positive results, but this has still been on the back of some significant reserve strengthening actions, especially on the casualty side, by a number of major players. Capital, new company formations are still very, very limited. So we see new capital being very cautious about this new investment environment. And despite the benefit of the higher interest rates in a number of aspects, what we can see as well is that from an investor's point of view, that means that other options remain probably more attractive than reinsurance at some point. So all in all, what we see is a very positive prospect in terms of returns, but with companies still catching up and will need a bit more time to see how stable those factors are. In terms of near and medium-term prospects for the global reinsurance segment, I would say the main point is that this rebalancing of interests between the primary and the reinsurance sector are here to stay. Increasing demand from cedants for reinsurance cover, that's clear, but we don't see anytime soon reinsurers actually lowering attachment points or loosening terms and conditions. There is obviously pressure for more cover at the working layer level. Some companies may be able to provide increased capacity in terms of quota share treaties, but that is going to be in a very selective basis, and what we are seeing is reinsurers putting significant pressure on primary companies actually to increase the rates first and improve the quality of their portfolios. So we think that any change in that respect is going to be very limited. On the other hand, I mentioned earlier about the possibility of new entrants in the market. And I think that, yes, we've heard about a number of potential projects here. The significance of that is still, from our point of view, very, very limited. We don't see significant flows of capital coming in, especially for new company formations. It's unclear whether new capital may be actually coming from other pockets from the broader industry. The idea of the exclusive niche reinsurer writing significant amounts of business and replenishing eroded capital from previous cycles, I don't think that that necessarily works in this case. Yeah, so first of all, we haven't seen capital being depleted this time, despite the significant cat loss activity, despite the depressed ROEs that we saw in previous years. Capital has remained at very robust levels. On the contrary, what we see is some of the major players thinking about probably distributing that capital. Yeah? So some of the global players actually haven't changed their policies in terms of share repurchases or special dividend payments. So yes, we'll see an increased amount of capacity, but the net amount is a point that we'll have to closely monitor. The other development that I will say is happening recently is some concern about US casualty business. Whereas 2 years ago, a number of players were very bullish about trying to rebalance their books, moving away from property cat into US casualty. That position at the moment has slowed down significantly. See, we've had some adverse experience, some reserve strengthening concerns about social inflation. They still remain. So it's not that necessarily casualty is going to shrink significantly. I would just say any growth is going to be very, very cautious. And lastly, what we see as well is increased concern about emerging risks in general. So on the one hand, we have all the questioning that we've had about the confidence in models that we've had in the past and the volatile results on traditional risks. But as the world becomes more complex in terms of the nature of the risks, the big question mark is how much of those risks are insurable and to what extent they can be made insurable through refining of underwriting, modeling, pricing techniques. And I think that that's probably one of the biggest challenges that the segment faces in this evolving economy.